So recently there's been a lot of talk about a bond fund called the PIMCO GIS Income Fund. And that's because this bond fund has a whopping distribution yield of around 6.3%. But perhaps what's even more amazing about this fund is the consistency of its payouts. Since inception, its distribution has remained remarkably stable and even saw a 30% jump in 2022. With nearly $94 billion in AUM, the PIMCO GIS Income Fund is one of the largest bond funds globally. So much so that it has become a core holding in various income-focused portfolios, including those offered by Endowus and Mari Invest. So, is this bond fund good to invest in? Let's find out in this video. First up, here are some basics about the PIMCO GIS Income Fund. This bond fund invests in a diversified mix of fixed income assets globally, across countries like the US, UK, Australia, Mexico, and more. Though, a large portion of its exposure is heavily concentrated in the US, followed by the UK. That's because both countries currently offer relatively high yields of around 4.5%, making them attractive for income-focused strategies. Also, if you look closely at the holdings, the fund also has some positions showing negative exposure. This is due to the fund having short positions in these countries through the use of derivatives. For example, if you go through the fund documents, you will see that they have futures, options, credit default swaps, as well as interest rate swaps on this fund. In terms of industry diversification, the fund has close to 11% holdings in banks, and the rest are spread across other industries such as electric utility, aerospace, pipelines, automotive, and so on. As a whole, the effective duration of the holdings is around 5.38 years, estimated yield to maturity around 6.71 years, and it has an average credit quality of AA-, which puts this fund in a high grade rating. What this essentially means is that this bond fund has the same risk level of long-term bonds issued by the three big Singapore banks, aka DBS, UOB, and OCBC. And since this is an actively managed fund, this fund has a rather high 1.45% management fee. Though, if you invest in it via Endowus, you'll be able to get a much lower 0.55% management fee. Add in Endowus 0.3% platform fee, and you will end up with just 0.85% total fee. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? There, here it is. You want to check out analyst ratings? There, here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today, and let's get back to the video. Now, when you dive into the top 10 holdings, things get a little more interesting. Here, you will notice that a large portion of the fund is invested in something called FNMA, which stands for the Federal National Mortgage Association, or commonly known as Fannie Mae. These are essentially mortgage-backed securities, financial instruments backed by pools of home loans. In fact, if you check the portfolio breakdown, about 34% of the fund is in agency mortgage-backed securities, while the rest is spread across a mix of government-related bonds, corporate bonds, and other credit assets. If the term mortgage-backed securities sounds familiar, it should. These were the very instruments that played a key role in the 2008 global financial crisis, causing widespread panic and market collapse. However, before you be like,
this fund has mortgage-backed securities, therefore it is a backed bond fund.
Here are some things that you should be aware of. Firstly, these securities are considered relatively safe due to their implicit government backing and regulatory oversight by agencies such as the Federal Housing Finance Agency and the Department of Housing and Urban Development. But don't get me wrong, GSE-issued MBS are not officially guaranteed by the US government, though they do benefit from implicit federal support, as demonstrated during the 2008 financial crisis when both Fannie Mae and Freddie Mac were bailed out and were given access to US Treasury credit lines. Secondly, the lending environment today is much more tightly regulated than it was pre-2008. Back then, subprime lending practices were rampant. Banks were approving risky loans with no income, no jobs, and no assets, or known infamously as ninja loans. Today, underwriting standards are significantly stricter, with lenders requiring full documentation, verified income, and creditworthiness before issuing mortgages. Or, to put it simply, unlike the subprime instruments of 2008, today's MBS are a lot more stable, better regulated, and backed by higher quality borrowers. But then, how is this bond fund able to deliver such consistently high distribution, even in today's volatile interest rate environment? Short answer, capital distribution. If you look into its distribution breakdown, you will notice that not all of it comes purely from income. For example, in the most recent distribution, about 70% came from net distributable income, meaning interest and dividends earned by the fund. The remaining 30% came from capital, which can include realized gains or a return of capital. But then, if the fund is consistently liquidating its holdings to make distributions, wouldn't that gradually erode its net asset value over time? And if so, won't that affect your overall returns? Well, yes and no. That's because if you look at the fund's annualized returns anytime from 1 year all the way to since inception, the returns have been in the 2 to 3+% range, even after you have netted off the 5% preliminary charge. This is actually pretty decent. In fact, this is one of the rare fixed income funds that has outperformed its benchmark, which in this case is the Bloomberg US Aggregate Bond Index. Not just that, if you compare the distributing version of the PIMCO Income Fund versus the accumulating one, you will see that both funds give practically the same returns. However, if you compare their NAV, naturally, the accumulating version of the fund will have increasing NAV since they reinvest the dividends instead of paying it out, while the distributing version will have declining NAV. Which brings the question, should I be worried about the declining NAV, and will it eventually drop to zero? To be honest, I don't have the answer to this, since the fund manager doesn't share much of their investing strategy, other than a few short paragraphs on how they are positioning the portfolio and their outlook. That's why you need to know what is your goal and whether this fund fits your goal. This is important, especially if you are someone who got sold this fund by a banker or insurance agent and are now wondering if you should continue holding this fund after seeing its NAV drop. The main objective of this fund is to provide a high and consistent income, while long-term capital appreciation is just a secondary objective, aka nice to have, meaning if NAV go up, then good lor. If NAV don't go up, then too bad lor. This is very different from, say, this fund, where the objective is to achieve capital appreciation, or this fund, where the objective is to provide a total return of capital growth and income. Because of that, the PIMCO Income Fund is more suitable for people who prioritize consistent income over capital growth, such as income-focused investors, retirees, or individuals who need the payouts to supplement their income source. At the same time, given that this bond fund can be volatile, investors will need to have a mid to long-term holding period of around 3 to 5 years or more. But more importantly, investors will need to be comfortable with the active management approach of this fund. This means placing a high level of trust in the fund manager's expertise to navigate the complexities of the global bond markets, including tactical shifts in credit quality, duration, and even short positions across countries and sectors. So far, the team has demonstrated strong performance, consistently delivering attractive income with relatively managed volatility. However, as with any actively managed strategy, past success is not a guarantee of future performance. Okay, here's my take. If you have been following me for a while, you will know that I believe dividends are largely irrelevant. That's because they don't appear out of nowhere, and the money has to come from somewhere, either through earnings or by selling assets. That's why instead of getting overly excited about the 6.3% consistent dividend payouts from the PIMCO Income Fund, I prefer to look at the bigger picture, the fund's total return, and the future potential of my investments. Right now, as I'm in the accumulation phase of my life, I don't really see the value of adding this bond fund to my portfolio, but I can see why it might appeal to other investors, whether for diversification or as a source of steady money income. That said, you still need to be fully comfortable with the fund's active management style. So, if you're not okay with placing that level of trust in the fund team, then it might not be the right fit for you. In that case, you could consider simpler fixed income alternatives, such as the Singapore Savings Bonds, T-bills, fixed deposits, passive global bond ETFs like AGGU, or even CPF. Otherwise, if you're okay with volatility and equity risk, you could also consider globally diversified ETFs like VWRA and simply liquidate your positions when you need the cash, effectively creating your own income. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.